Hello everyone, welcome to another session of Revise as Pro. In this particular session of today, we would be covering the section A of part 1 of our US CMA syllabus known as the External Financial Reporting Decisions, and we'll be covering a specific topic under this particular section, namely accounting for taxes. So more around the concepts of deferred tax asset and deferred tax liability. And people who might be familiar with accounting know that this particular section in the US CMA syllabus around accounting is covered in the section A part 1, and generally it reflects the accounting syllabus which is heavily tested in a CPA or a basically ACCA examination. But here also it has a weightage of 15%, and specifically if we need to focus around accounting for the taxes, what are the areas we need to know, that we are going to cover here. So let's get started, right? So basically when we talk about accounting for income taxes, what is expected in the examination? Definitely we'll get certain small questions in the form of a MCQ involving the concepts of DTA and DTL as well as calculation, and there might be some journal entries that might be tested. In a essay questions, there might be involvement around treatment of DTA and how the permanent and temporary differences occur. There might be some questions around that, around strategy, or you might be need to explain these differences with some examples. So let's get to move into the key points that we should remember in terms of firstly permanent and temporary differences. So the first point states that the net income under GPFR, means general purpose financial reporting, which may be US GAAP or IFRS, can differ from the taxable income because of temporary and or permanent differences. Now, why is this somewhere happening? Is because the tax follows a particular law, while when we are preparing our book profits, we are either following the US GAAP or IFRS, depending upon the general purpose financial reporting that we are following. So what is the permanent difference and what is temporary difference? Permanent differences occur when GAAP income is not taxable or when GAAP expenses not deductible under tax laws. So it's a permanent feature, something which is not going to be considered for tax purposes, but is somewhere considered in the book, might be a revenue or an expense, and this will cause a permanent differences because such differences do not reconcile as they are not considered income or expenses under tax laws. Example, interest income received from government bonds, which is an income that is tax exempt, right? Similarly, fines and penalties expense, if you are made a fine, income tax is not going to leave you. So you will not get a deduction for that. So these are considered as income and expenses for the accounting profit computation, but not for tax purposes, resulting in permanent differences. So permanent differences will not result in any deferred tax asset or liability because these differences are not going to get reconciled in the future. Coming into temporary differences occur when revenue or expenses are recorded in different periods for book purposes compared to tax purposes. That means that might there be some revenue or expenses which are considered earlier in tax, later in books, or vice versa. Such differences eventually reconcile in certain period. It will ultimately or at the end it will get reconciled. Example, accelerated depreciation used for tax purposes. In taxes, we know the modified accelerated method of depreciation is used. So naturally for tax profit computation, the amount of depreciation initial years that would be available would be higher is compared to books, because in books normally might be the SLM method followed. So the tax profits will be lower in initial years because of higher depreciation compared to the book profits. Temporary differences result in deferred tax asset or a deferred tax liability. So everyone should be very much familiar with the permanent and temporary differences, and you should be somewhere clear that it is the temporary differences which is causing the DTA or DTL, because that might be a question in MCQ. Plus, there might be some questions around explaining these concepts with examples. So this particular slide deck is very important to remember the points for permanent and temporary differences. Now let's move ahead for further discussion. So the next part that we are covering is what are the key points that we need to remember around deferred tax asset and deferred tax liability. So first, deferred tax asset. Generally, when my taxable income is recognized before my book income, then a deferred tax asset situation arises. Why? This results the taxable income to be higher and the entity pay higher taxes and records a DTA, deferred tax asset in books, which will be adjusted subsequently as deferred tax expense when the income will be eventually recognized in the books. So what does it mean? It means that something has been recognized in the tax profit computation earlier, the income. As a result, we have to pay taxes higher, but it is not recorded in the books in that particular period. So naturally, the taxes which are paying higher we recognize as a deferred tax asset, and eventually when that is recognized in the books, we have to make an adjustment with the deferred tax expense. Example, say company A sells 2 years magazine subscription. For book purposes on accrual basis, the first year revenue recognized, later year shown as unearned revenue. For tax purposes, subscription received, whatever it is received in cash, fully taxable in the year of receipt. So company A pays tax and records a deferred tax asset to the extent of the unearned revenue, which is to be recognized in the later years, and that is to be adjusted with the balance revenue recognized in the books. So naturally, what is the tax rate that is applicable on that portion of the revenue which is not recognized in the books? A deferred tax asset gets created. Then comes deferred tax liability, just the opposite scenario. What happens when generally the book income is recognized before my taxable income? So this results my taxable income to be lower initially, and the entity incurs less taxes and records a DTL in the books. Means he's recording a deferred tax liability because he has to pay the taxes later on, for which it has not recognized the income in the tax books yet. Now, this will be adjusted subsequently when the income will be eventually recognized for tax purposes. So that is a scenario of DTL. Example, say company A follows the SLM method of depreciation for book purposes and accelerated method of depreciation for tax purposes. So this will result my tax depreciation amount to exceed the book depreciation in initial years, causing the tax profits to be lower than book profits and leading to a lesser payout of taxes initially. Hence, company A will record a deferred tax liability in the books. So these two examples, if you keep in mind, it will help you to relate the concepts when it's tested in an examination. Coming into the remaining points, the deferred tax asset and deferred tax liability are calculated using the enacted tax rates from the future periods in which the timing differences are expected to reverse. So the enacted tax rates is a catchword that might be coming in the MCQ, where they may ask you how the DTL and DTA and the DTL are basically calculated. My total tax expense is going to be a combination of my current tax expense, amount of my tax liability in the current year tax return, deferred expenses, and changes in the DTA and DTL. This is again very important, what is highlighted in red. So the total expense, how it is computed, that should be kept in mind. Finally, how is the presentation happening? The DTA and DTL are netted together, and based on the net balance is shown as a long-term asset or liability on the balance sheet. What does it mean? If my DTA is higher than my DTL, then naturally it will become an asset on the balance sheet shown as a long-term asset. If my DTL exceeds my DTA, the net is liability, so it comes as a long-term liability on the balance sheet. So these are around the basic concepts of DTA and DTL, which we should keep in mind as a part of a revision. There might be a lot of questions that might be somewhere practiced using these concepts, but since it's a revision mechanism we are following, we're trying to highlight on the key areas. Now let us move ahead to see what is there further in our revision process. Next thing, as we have a quick problem to solve, that is the concepts that we have understood, how a question may be asked on that. So let me move into an Excel by quickly sharing the Excel screen. Just give me 1 minute. So I'll just go to my Excel, and I'm just sharing it. Yep, we are into the Excel. Now we are trying to here solve a question around the deferred tax asset, and it can be around deferred tax liability also, but the purpose is to how to approach this problem, what can be asked. I'm trying to help you out on that. So the problem states that the company A receives $1200 payment in December 24 for a 25 subscription. Understand that it is received in 24, but it is for 25. In the books of the company, we'll record $120 as revenue in 25, while it will show the same as unearned revenue for 24, right? Because it is something which is to be a revenue for the next year, but it has been received in advance. But for tax purposes, the $120 received will be considered as income in 24 only. If the tax rate is 20%, then it will result in a tax payment of 20% of $120 amounting to $2240, and the DTA to be created the same amount in the books, because we have to pay the taxes in advance, and to the extent of the taxes we are paying advance by applying the tax rate, we are required to record a DTA. Now, if you see the rate font highlighted, this is for your help. In this scenario, what is happening? The company has paid its tax on revenue in 24 for income to be recognized in the books in subsequent 25. So what are the journal entries that is going to happen in 24? We are recording a deferred tax asset, DTA, to deferred tax benefit of 240. And then in the next entry, it's like the current tax expense debit to tax payable for the 240 amount. Now, in the subsequent year, in 25, what is happening in 25, when the revenue is recognized, the company will not have any tax payable on the said income as it has been already paid. So the DTA will be reversed to show the tax expense. So what is happening? Deferred tax expense debit to deferred tax asset. So if you find out from the 2 years journal entries, the deferred tax asset which got created in 24 is now getting reversed. And that is why we said in our points that in case of a temporary differences, ultimately it gets reconciled. So in 24, what got created as DTA is getting reconciled in 25. So this concept should be kept in mind. So this is a small problem that may come in an MCQ, but it may so happen that involving the concepts of DTA and DTL, you may have multiple sub questions forming a part of your essay question, right? So with this, we quickly move back to our PPT to see what is left for us to revise. Just give me 1 minute as I move to the once more to our PPT. Great. So with the PPT, as we have solved the problem, so in terms of this session, what we discussed was the concept of temporary and permanent differences, the concepts of DTA and DTL, and how we can get tested with a MCQ or that of essay questions around these concepts. So with that, I think we have come to the conclusion of this session. I hope that this small session was helpful for you to revise the concepts of accounting for taxes, and we would be also circulating concepts as well as revision sessions for other topics of USCMA. So please continue following the Uplift platforms, and if you like these videos, please subscribe and support the views. Thank you.